Hi everyone, thanks for joining us today. My name is Paul from First Macro Capital. We're an independent research firm for individuals and professional investors looking for market cycle opportunities across different sectors. Today's update is we're going to talk about when the tech unicorns become horses again, because if it can happen to Amazon, are these new unicorns truly safe? Throughout this update, we're going to talk about where we are in the IPO cycle, lessons from the great Sir John A. Templeton. If it can happen to Amazon, it can probably happen to them, and what it potentially means for the NASDAQ going forward over the next few months, as we're seeing history repeat all over again. Just a general disclaimer, we're going to be making some forward-looking statements. We're not here to make investment advice, so do your own due diligence. So again, if you get the cycle right, many people look at deep value opportunities, great stories, and the cycle multiplier. But if you look at the IPOs that have come to market right now, they're definitely not deep value. Maybe they've got a great story. Question is, where are they in the cycle? So potentially pointing us to the end of cycle phase for them. You know the names: Lyft, Uber, the Railroad, Jumia, Slack, Peloton, Beyond Meat. There's some of them have been tech darlings. Beyond Meat has been the non-tech darling that has done well recently, one of the few. And then you've had WeWork run into trouble. But let's go back a second from the IPOs from the 2000 bubble. The late John Templeton, one of the most successful investors the world has probably ever seen, said this about the 2000 tech bubble. This is the only time in my 88 years when I saw the technology stocks go to 100 times earnings, or when there were no earnings, 20 times sales, said Templeton. It was insane, and I took advantage of the temporary insanity. Templeton back then has been said that he shorted 84 NASDAQ stocks, taking positions averaging $2.2 million each. In nearly half of the shorts, he waited until prices dropped to 5% of what he paid, thereby cleaning up much of the names as Fundry Networks, Breakaway Solutions, Vitra Technology. Many of these companies don't even exist anymore. At other times, he closed out his positions once the stock price below 30 times. He took losses early, quickly covering positions when the stock price increased post-lockup. He focused on tech shares selling at three times the price set in the initial offering, rightly figuring company insiders would cash out some of their absurdly valued holdings, putting toward pressure on stock he suspected was due to fall anyway. The early 2000 overpricing of NASDAQ is what he called a once-in-a-lifetime opportunity. Templeton at the time didn't think it would recur in his lifetime. Now let's fast forward today. The similarities of this year's tech unicorns IPOs have all the same of the tech bubble of 2000. No earnings and 20 times sales for many of these IPOs on valuations when they became public. While Templeton waited over 80 years for his tech bubble to occur in valuations and whatnot, it took then less than 20 years for the tech euphoria to occur all over again. Some of these companies will be wonderful businesses potentially to own when the prices fall down, and some may never see their IPO highs again. Then in this cycle, we saw SmileDirect IPO do what no IPO has done since the top of 2000, to raise more than $1 billion and still sink from its IPO price. When SmileDirect did its trading debut, it sank by over 28%. Massive. Here's a look at some of the returns of the recent IPOs, where there's probably more pain coming because we've only seen the U.S. manufacturing start to further turn down and approach below 50 going forward. And you're looking at global PMIs that are coming up in the next few days. But let's just look at these IPOs. Really, only 3 out of all these IPOs, Beyond Meat, Zoom, and Pinterest, have so far posted positive returns. The rest of them are all posting at least negative returns going forward. This is as of last Friday, so you've got Jumia, Lyft, Slack, Railroad, SmileDirect, Uber, CrowdTrade. They're all posting negative returns as of last Friday. What happens when the second batch of IPOs go public? What are the investors going to sell to buy these new IPOs? Will investors even participate after getting burned from these first batch? Is the SmileDirect IPO flashing a warning sign? Now we've got problems with the WeWork that potentially may not even have cash by the end of the first quarter of next year. What happens with things like Palantir, Postmates? We've had withdrawals from WeWork and Endeavor recently pull their IPOs. Plus, there's one thing that really some people aren't even talking about still. We've got a lot of the lockup expiry expiration of shares that will put pressure on their share prices going forward. We've got Jumia in October. We've got Pinterest. We've got Zoom, Beyond Meat, Uber Technologies. This is further potential demand pressure that's going to be put on these share prices going forward. When Amazon peaked back in late 1999, from its peak, it fell by over 93%. Remember, 93% Amazon fell before it became this trillion-dollar company. The public markets today are quickly acting, giving these new IPOs a reality check. Many are only down, if we look here, anywhere between 1 to 50%. So if you're looking for the massive potential big gains like Amazon, going forward, coming out of this cycle, there potentially could be more pain coming forward. As we got into 2001, 2002, we saw the economy in the US slow down. So the question remains, will history repeat itself? The important thing is to understand where you're on the cycle, not just the tech cycle. It gives you an edge on where you should participate or avoid doing the mistakes of past investors. So if it can happen to Amazon, what does it also mean for the NASDAQ? When we look at when Amazon peaked in late 1999, we saw further acceleration into the big holdings of the big NASDAQ names, like Microsoft, Cisco, Intel, Qualcomm, back in that. And they accelerated for the first quarter of 2000 as a blow-off top, and then it went down from there. Some people are talking about a megaphone structure. Who knows? But I'm just looking at history. This is what happened, and potentially we'll have to see how it plays out. An important month coming in October. We've got earnings, so we'll have to really see how these companies start to see. We'll have to see if there's any indications with FedEx and Carnival that have recently given warning shots going forward. We'll have to see if the demand drivers can really accelerate in these key tech names. So again, just want to thank you for your time. You can check us out at firstmacrocapital.com. We just released a video last week for our clients. We've got a new report coming out this week.